The crypto markets were rocked early Friday morning in the Asian session, total market capitalization wiping out nearly 4%, plummeting from $3.87 trillion to $3.74 trillion. Bitcoin dropped 3%, falling below the critical $115,000 level, while Ethereum plunged more than 6%. Now hovering around $3,600, this wasn't just a price correction, it was a sentiment shift. Major altcoins like XRP, BNB, Solana, Cardano, and Sui posted even deeper losses. Down 7% to 12%. Meme coins such as Doge, SHIB, and Pepe weren't spared, each shedding over 10%. The crypto fear and greed index dipped from 72 to 65, remaining in greed territory but signaling cracks in the euphoria. While volatility creates panic, it also breeds opportunity, but to take advantage, investors must understand the 5 core forces driving this sharp correction. First, macroeconomic pressure and monetary policy remain at the forefront. The Fed's preferred inflation gauge, core PCE, rose 0.3% month over month, pushing the annualized inflation rate to 2.6%. The CPI also ticked up to 2.7%, reinforcing that inflation is proving more persistent than markets had hoped. Simultaneously, a resilient labor market reduces the urgency for a Fed pivot. The Federal Open Market Committee left rates unchanged at 4.25% to 4.50%, signaling a wait-and-see approach. Jerome Powell emphasized that tariff-related inflationary impacts are now visible in economic data. CME FedWatch shows that markets now expect just one rate cut by year's end, a stark contrast from earlier projections. However, this may soon change. On August 1st, Donald Trump publicly warned that the Fed must act if Powell delays rate cuts. This added a new layer of political tension to an already uncertain economic environment for crypto investors. Higher rates typically translate to weaker liquidity and reduced risk appetite, but the potential for a political showdown over rate policy also opens the door to sudden market reversals if expectations shift. Second, the expiry of over $7 billion in Bitcoin and Ethereum options triggered preemptive repositioning. Traders became defensive, especially as Deribit recorded the largest put option volume ever, targeting a Bitcoin drop below $110,000 before August 8th. The day's expiry involved $5.72 billion in Bitcoin options and $1.35 billion in Ethereum options, with Bitcoin dipping below its max pain point, around $116,000. Cascading liquidations and forced closures created downward pressure, yet this mechanical selling also creates entry points. Historical data shows that options expiry events often result in short-term spikes in volatility followed by stabilization. For contrarian investors, the panic around expiry dates can be fertile ground for accumulation. If macro factors don't worsen, third, capital outflows from spot Bitcoin ETFs and related funds compounded the pressure. Thursday saw $114.8 million withdrawn from spot Bitcoin ETFs. BlackRock's EBIT recorded a modest inflow of $18.6 million. But funds from Fidelity FBTC, ARK21 shares ARKB, and Grayscale GBTC all reported significant outflows. Global Bitcoin fund flows, according to CoinShares, showed a net withdrawal of $175 million, a near total reversal of institutional inflows in recent net. Weak institutional sentiment is a double-edged sword. While large-scale outflows can accelerate sell-offs, these same institutions tend to buy heavily during market weakness. Price drops driven by short-term sentiment often precede new positions once prices stabilize, making it crucial to watch ETF flow data closely for signs of a pivot. Forced liquidations tore through the market. Nearly $1 billion in crypto positions were liquidated in the last 24 hours, affecting nearly 200,000 traders. The largest single liquidation came from an ETH-USDC pair on Binance, valued at $13.79 million. Most losses were from long positions, about $900 million, while shorts accounted for roughly $100 million. Solana, XP, Doge, Sui, ENA, and ADA bore the brunt of the damage. These liquidation waves are painful but not unusual in crypto's high leverage environment. They often mark capitulation points, which, paradoxically, also signal local bottoms if open interest clears out and leverage resets. The market may find a new foundation to rebuild, however. Without a catalyst like rate cuts or institutional accumulation, the recovery could take time. Fifth, on-chain data is flashing red but also signaling strategic inflection points. Over 90% of Bitcoin's circulating supply remains in profit, a condition that's held for over a month according to Glassnode. This increases the likelihood of profit-taking. The cumulative mean plus one standard deviation metric is currently at 91%. Breakdown below this level would confirm renewed sell pressure from long-term holders. Coinbase premium gap has turned negative, implying reduced American buying. Demand simultaneously, the kimchi premium is negative, suggesting strong selling activity in Asian markets. Both indicators confirm that global appetite for Bitcoin is weakening in the short term, but historically, when supply is in profit and metrics turn bearish, the market often enters a period of consolidation before rebounding in conclusion. This crypto market correction is not a random event. It's a confluence of macro headwinds: options-driven volatility, institutional outflows, mass liquidations, and profit-taking. Each factor presents risks, but also strategic entry points. For long-term investors who understand the cyclical nature of crypto, the storm has arrived. The question is, are you prepared to survive a tour strong enough to capitalize on what comes next? The recent shakeup in the crypto market, which saw a near $130 billion wiped from total market capitalization, is more than just a reaction to temporary fire. It's a convergence of macroeconomic pressures, strategic institutional repositioning, and fragile investor sentiment. At the heart of it is the escalating inflation narrative. With the U.S. core PCE rising 0.3% month over month, lifting the annual inflation rate to 2.6%, while CPI accelerated to 2.7%. These figures, though not catastrophic, signal that inflation remains sticky. It's not transitory in a market addicted to stimulus and cheap borrowing. Any sign of extended high interest rates becomes a catalyst for capital flight from volatile assets like crypto. Jerome Powell's stance, reiterating that tariff policies are already reflected in inflationary pressures, which only adds to the uncertainty, with the Fed holding rates between 4.25% and 4.50%. Investors now expect at most one rate cut by year-end. Far cry from earlier hopes of a more aggressive easing. Add to that the looming political tension, where former President Donald Trump publicly pressured the Fed to act or face consequences. And the market is caught between economic fundamentals and political unpredictability beyond macro forces. Technical pressures are compounding the volatility. The expiry of over $7 billion in Bitcoin and Ethereum options caused a seismic ripple. Traders anticipating downside risk piled into put options on Deribit, aiming to drive BTC under $110,000 before the August 8th deadline, with $5.72 billion in Bitcoin options and $1.35 billion in Ethereum options expiring. The market faced aggressive repositioning. The result: Bitcoin briefly dropped below its max pain point near $116,000, triggering a chain reaction of forced liquidations and risk-off behavior.